Hey guys, so for this week's video, we're going to go a little bit different here. We're going to go away from the algorithmic trading and the trade ideas and building strategies, and we're going to go to some more basic stuff. Because when I talk to a lot of my clients and stuff, uh, they have very good knowledge of technical analysis and this type of thing, but some of them are actually missing just the fundamental of securities and what it is they're actually trading. So I'm going to do a intro to derivatives series, and if it's popular and you guys like this one, I'll go deeper into the derivatives market and give you not just an overview of how to trade this, but what you're trading, and that knowledge may actually just increase your results in and of itself. If you have a bit of a basic understanding, you wouldn't try to race cars without having somewhat of an understanding of how they're built and what they do and that type of thing. So I hope that this helps, just a base knowledge. So this is going to be the basics of derivatives, just an intro of futures, options, how they were created, and what they were originally created for. And from then we can go, again, like this video, share it, comment. If you guys like this kind of stuff, I'll keep doing it. We'll go on trading strategies, on different calendar spreads, flies, vertical spreads, these type of things. Very deep we can go. This is just going to be a very basic intro to test to see if this is something you guys are interested in. So, futures versus options, and we're just going to go very, very basic here. So, first of all, myself, if this is the first video that you're stumbling upon, my name is Michael Nauss. I am a chartered alternative investment analyst, as well as having a certificate in derivatives market strategies. My current focus recently has been on algorithmic trading, on computer program trading, that type of thing. But my education background and actually my work background for many years has been on derivatives investments, hedging, risk management, these type of things in derivative investments. So these two designations, one's a US and one's a Canadian designation. One is focusing on all types of alternative investments. So we're talking hedge funds, private equity, real estate, credit derivatives, these type of, and any sort of the really weird stuff. The derivatives market strategies was about hedging and creating risk management strategies and trading strategies. And this is a Canadian one, so it's primarily focused on real estate and energy, which is what we do up here. So futures versus options, just definition. A future is an obligation for two parties to trade at a future price. It can either be cash delivered or actually delivered. So if we're going to trade oil 3 months from now and we want to lock in a price for that, we can use the futures or the forward market there. And I just put that it's a simple agreement. It's me going to you saying, let's do this deal for this amount at this future price. Very simply. We all know futures. Again, most of my audience are going to be traders. We trade the front month contract. We trade oil, gold, whatever. But that price that we're actually trading is what we believe the future spot price will be. Again, we can go into how that spot price and the future price differ. We can do all these things. We'll do that at a later video, again, if you guys are interested. So that versus an option. An option, one party has the right to trade at a price, the other party has an obligation to trade at that price. So think of options as an insurance policy, right? Instead of the oil trading at $100 and two parties coming together and agreeing that we're going to trade at this price, what we're doing is I am going to issue an option to someone else to trade at this price at a later date. Now it's up to me whether or not I am going to exercise that option, and it is up to the other party to have the obligation to exercise that option. So me, as basically buying insurance, I am going to pay a premium for that person to incur the risk of a later expiration. So if, again, we use the $100 oil example, if that's where we're trading, and I want to lock in that price, I can create a contract that would give someone the obligation to trade at that price later. Now, what I'm doing is I'm transferring the risk to that person. So to transfer the risk to that person, I have to pay them a premium. And when the option is actually traded, it is trading at that premium. So that premium is going to incorporate a lot of things. Again, if this is popular, I'll dump in a later video. It's going to include how much time is left on that contract, what's the probability that we're going to be near whatever price we decided, that $100 at that time. So the more risky it is for the other party, the more I have to reward him with a higher premium. So from here, I'm going to go to two different examples. I'm going to go a baker and a farmer, and an oil, natural gas producer, and an energy producer. And I'm going to show how you could use options and futures, how they were originally built to work in an ideal world, and how they actually work in the real world. Because ideal and real, as we know, is completely different. It's book learning versus the street. So here we're going to start. We have a baker and we have a farmer. Right? These are the two parties in this. So they both trade wheat, right? It's very important for the baker to have wheat, and it's very important for the farmer to grow wheat. So they're both worried about what the future price of wheat is. So what we're going to do with them is we're going to figure out, okay, so if we're looking for whatever the future price is, the baker, obviously, if the price of wheat drops, his margins will increase and he'll make more money. The farmer, if the price of wheat drops, he'll be able to sell it for less and his margins will decrease. So although everybody's worried, they're both worried for different reasons, right? But these two parties are going to be linked. It's very important for these two parties. They need each other. Without one or the other, their business is useless, right? So how are they going to go through their different, how are they going to talk to each other, right? So ideally, this is what exchanges are created for. So that, say they both like the current price of wheat, and that's about $10 per bushel. What the baker is going to do is the baker is going to go to the farmer and say, I like the current price of wheat. Do you like the current price of wheat? If so, what they're going to do is they're going to settle on a deal, right? The $10 a bushel, this is what wheat's cost. I will sell you the wheat at a future time for a certain amount at this price. So they have both locked in the price, and that's how the future contract would work. And again, that's an ideal world. But in an ideal world, you're not going to find a baker and a farmer that are both going to need this certain price for this certain process. It's just not going to happen. So what we're going to have to do is we're going to have to include a third party. And the third party, we'll just mark him as S, is the speculator. So the third party is generally us who trade, right? So when the world looks at traders, they generally look at degenerate gamblers and people who are just out there to make profit. And that's 100% right a lot of the times, but we need them. And this is why, because if we can't match every farmer and a baker together, then somebody else has to be the intermediary in the trade. And that's where the speculator takes place. So the speculator, what he'll do is he will buy the wheat from the farmer for a slight discount and then try to sell it to the baker for a slight profit. So this is what the speculators on the floor have been doing for futures for years. If I have a bunch of wheat and I want to sell it at that future price, I'm just going to go to the market, I'm going to sell it for whatever it's trading. It's important that we have these speculators because they keep the market tight and they keep it liquid and they keep it active. So what they're doing is they're basically assuming the risk from the farmer in hopes to be able to sell it to the baker at a higher price later, right? So it's a risk transfer. So where ideally a deal is made directly, quite often a deal cannot be made directly. Therefore, we need a trader as an intermediary. So let's get rid of this and let's talk about how they could do it through options. So if I'm a baker and I need to lock in a price, so we'll focus just on the baker right now. My worry is that the price of wheat is going to increase. And if the price of wheat increases, my margins shrink to maybe to the point where I don't make any money on selling breads and I'm out of complete business as a baker. So what I might do is I might buy an option. So what I'm going to do is I'm going to purchase an option to lock in the price at $10, right? So we'll just write in a 10 and a dollar sign, right? So I am trying to lock in the price of wheat where it is now at $10, because as long as it stays at $10 or below $10, I'm fine. But if it goes too far above $10, I lose money, right? So I need to go out, and again, this is where the speculator comes in. The speculator will take that deal and he will sell them that option, but he obviously won't do it for free. So say the baker pays a dollar, and the baker is going to pay $1 for this contract. Okay, so we have a $10 option to buy wheat, right? And we paid $1 for that option. And that's our insurance premium. So at the end of all this, one of two things is going to happen, right? We have one of two options with wheat. And we'll just mark wheat as W, right? So our one option is that wheat is higher than $10, right? So say it's trading at 12. So then what the baker does is the baker can go to the speculator and say, okay, I am going to buy this wheat from you for $10, even though the market is trading at, sorry, we'll get rid of this. The market is currently trading at $12. So then he has locked in his price, which is really $11, because he's paid $10 for the wheat, plus he's paid $1 for the initial insurance policy. The second option is that wheat is trading at $9, right? So wheat has gone down in this time where he needs to refill his order. So what will happen is the baker will do nothing, right? The baker will simply go to the market and buy his wheat for $9, but effectively his cost is $10 because he still has to pay the speculator his $1 for his contract. So you can see that this is a way to build an insurance policy which isn't necessarily, it's not the greatest way to do it, but if you're very worried about a price shock one way or the other, it would be the best way to do it. So now again, I'm a guy who likes multiple examples. So let's just go to this second example and we will look at the same thing in the same way, and we'll see how it would happen ideally or in the real world, right? So again, ideally you have a natural gas producer and an energy producer that uses natural gas, right? So we have the seller here and we have the buyer here. Just like the wheat and the gas, ideally they meet up perfectly. Ideally you have a natural gas seller and an energy producer, and the energy producer needs, say the energy producer's energy price is regulated by a government or there's competition in the market, however it happens. So he can only sell energy at a certain price. Again, we're going to leave numbers out of this one to see it, just to visualize. So ideally the natural gas producer, or the natural gas producer and the energy producer, they meet and they work out a deal. This is what we're going to sell everything for, so that everyone can set their margins, they can run their businesses, and everything is fine. Any price shocks we're not too worried about. Again, that's the way it would work in an ideal world, and that's a simple future contract between the two of them. You're not really going to get that because, say, this natural gas producer produces so much energy, he can't just sell it to this guy. He has to sell it to a lot of places. So again, this natural gas producer is going to go down to the exchange. We'll denote exchange as E, and he will just sell the future natural gas that he'll produce, right? And maybe the energy producer buys some right away, but can't buy enough. So once again, we bring in the speculator, and the speculator will then buy that energy in hopes of selling, right? Buying the natural gas in hope of selling the natural gas for higher later. So again, it's a transfer of risk. And again, that is done with natural gas futures that are traded constantly. So the more these things are traded, the less risk, because you can adjust positions anytime you want. And then again, how would we do this? Again, from the producer side with options, right? So the producer side is looking for the right to sell, right? So this would actually be a put option, whereas the other would be your typical call. So he is looking for the right to sell natural gas at, I like easy numbers, so let's use $10 again per cubic feet, I believe it's measured in. So he is selling this for $10, but since he is selling, he is giving the right to sell, he needs to find someone that is willing to buy later, right? So again, the speculator is going to come into place for the option, and he is going to do this deal for $1. So $1 gives him the right to sell natural gas, whatever quantity is decided on, for $10 per cubic feet between now and whatever date is decided. 3 months, 1 year, 2 years. It's going to depend on the contract. So, as a speculator, right, we want to lock in our $1, and our bet is, so the speculator takes on the risk, but the speculator has has more options to make money than the natural gas. This contract is worth a lot of money only if the price of natural gas drops significantly. Whereas the speculator will make money if the natural gas remains at $10 or moves between $10 and infinity, right? He is going to collect his dollar regardless because the natural gas person is selling the contract. So again, two options. One, at the end, at expiration here, natural gas price is, say, $6, right? What the natural gas producer is going to do is he's going to go to his speculator, and he is going to exercise that contract for $10 and sell him the natural gas for $10 minus, right, the $1 that he paid. Whereas the speculator is now at this loss because he needs to get the natural gas from the market for $6 and then pass it forward, right? The other option is that the price drastically increases, and let's say it's $15. The natural gas producer, again, is not going to exercise his contract because why would he sell it for $10 when he can sell it for $15? But still, you have to always keep in mind the $1 the natural gas producer paid for the contract has been put through. So this is how derivatives, a very scary word, a big media buzzword, this is how derivatives were initially designed. They were designed as a risk transfer method. So I am assuming some risk for whatever it is, but I am not in the business of risk. I am in the business of producing energy, producing bread, producing wheat. This is what I do. I would like to transfer my risk either directly to the other side of the transaction, or when that can't be found, which is which is very, very common, I can transfer my risk to a speculator through a financial derivative. So again, guys, I hope that this shed some light. People who are new to derivatives, people who are new to this type of thing. Again, I have a wide wealth of knowledge on this topic, so if there's anything you guys would like to see, or even if you just want me to go deeper into futures, how they're priced, deeper into options, how they're priced, maybe some risk management tools for portfolios with both of these things, let me know. Links down below or on Twitter. My email will be down below as well. And I'll do something else for you guys next week. So until I see you guys, trade safe.